Good day, fellow investors. Over the past week, 2 weeks, I have analyzed 7 aluminum stocks and the complete aluminum investing sector. In this video, we're going to discuss 5 aluminum stocks, of which 2 are really interesting, good, great businesses that might add value to your portfolios over time. For those 2 companies, we're going to put them into our intrinsic value template. I'll give you later the link where you can download it and put different values over time in it so that you can follow what's going on. I'll give you a complete aluminum investment strategy and fundamental sector thesis when discussing all the stocks. That's why you always need to do a full sector analysis, because then you know really what are the values and the opportunities in the sector. And throughout the whole video, we're going to discuss 7 investing concepts that are key when it comes to investing, from cyclicality, volatility, fundamentals, long-term, short-term, government involvement, and of course, modes. Let's start with the analysis, discussions. If you get value from this, all I ask is to click that like button, and if you haven't, consider subscribing. So, aluminum is used everywhere. If you just open a good, nice cold beer, perhaps not in these winter times, but that's aluminum. Cars, planes, a lot of usage globally, and as the global population expands, and over the next 10 years it's expected that the global middle class population, so the people that buy cars, drink beer, it is expected that the spending will almost double, perhaps even more with all the stimulus that's going on. Aluminum is a commodity, so if India grows, Asia, the rest of Asia, China continues on its plans, then by investing in aluminum you also have exposure to global economic growth, which is still positive from both a demographic development and all scenarios. So very interesting way to get exposure to those countries that you really can't get direct exposure, or it's very difficult, like India, for example. If we look at the usage of aluminum over time, it has been growing as global GDP, economies, and middle class population grew. Now, if you look at analysts, this is from Fitch, they see oversupply, but that oversupply subduing over time, and then again going into oversupply by 2024. However, if I look at aluminum prices, when analysts think there will be oversupply or there is, aluminum prices go down. But as soon as there is sense of undersupply, aluminum prices spike up, then down, up, down, up, down, up, down. Really small changes in positive or negative expectations have huge impacts on aluminum prices and even bigger impacts on aluminum stocks. And that's the investment thesis. Long-term fundamental investment thesis could be okay depending on the stocks you're selecting, but the really low-risk, high-reward investment thesis is to really play on the positive long-term fundamentals at really bad times. As downturns in aluminum happen every 2-3 years, there is really the potential to take advantage of the upside with really low risk. Why do I say low risk? Because the forecasts are that aluminum will be consumed more and more. So you have an underlying fundamental positive structural trend supporting your fundamental and lowering your investing risk. Just here to show you what kind of situations happen. So in 2016, where it looked really ugly for commodities, these were the analyses written. This is for Aluminum Corporation of China. Here is your chance to bet against China. Going to zero. My best short idea for 2016. The stock was at 750. Immediately it went up to 9, so the shorts got burned, then nothing, and then for those who were still shorting, look at this explosion. So yes, bad times, there are bad times, but the volatility is there and the positive trends are there too. All in all, China controls the market with production, with subsidies, which makes it a little bit tricky and something very important to watch. On the negative side of the fundamentals, what is used to produce aluminum is bauxite ore, which there is plenty of it. So you can't really have a mining advantage like other mining stocks that we analyze of this channel have. So it's not about the ore, it's about costs of electrical energy. And those depend on inputs, hydropower, natural gas, coal, whatever is used to make aluminum. If input prices go up, then also aluminum prices go up. But it's very difficult to create a long-term sustainable moat, especially as China, with its subsidies, money printing, and giving money to Chinese state-owned companies, it's really pushing the aluminum price down. For now, let's see how will that evolve over the next decade, and I'll be following this for decades, hopefully, onward. And these are the 7 concepts that are key to watch when it comes to investing in aluminum stocks. Let's dig into the stocks, apply these concepts, and then you'll see what fits your portfolio over time. I'm going to start with Alcoa, briefly touch on Century Aluminum, then focus my analysis on Kaiser Aluminum, great business, Norsk Hydro, Norwegian aluminum, very interesting, good business, and then briefly touch on the Chinese investment option, Chinalco. Let's start with Alcoa. As you can see, Alcoa is a stock with a lot of history, and if you read this book, Common Stocks for Uncommon Profits by Philip Fisher, written in 1951, you can find Alcoa, and he discusses how great it was to apply the new technologies in producing aluminum and distributing it in the American economy of the 1930s, 40s, 50s. So very, very long-term investment, did well over the last 100 years, but now it doesn't look that great anymore. We have seen, of course, the commodity booms and busts in the 2000s, big boom, so up to 2008, then the financial crisis destroyed aluminum demand. They were investing heavily here, all the sector, overinvested, oversupply, which really crashed the sector. Also commodity input prices crashed, and we have reached really the lows in 2020, but rebounded more than 300% since then. Why is the stock of a company so volatile? Well, because here people were expecting close to bankruptcy or really zero added value. When stimulus came in, when demand, especially from the automotive sector, came back, the stock quickly recovered. So with Alcoa, you can bet on recoveries as the cycle is really staggering. Look at all the ups and downs and how fast it goes when it goes up and down. So this is the investment thesis, and then you'll see which level of risk better fits you. Alcoa focused on the Americas with operations in Australia and the lowest cost input electricity in Saudi Arabia. And you can see here the cost curve for Alcoa's production facilities. They just sold part of the Warwick mill to Kaiser, but let's say on average the costs are not really advantageous except for Ma'aden. So average cost producer with other legacy issues. And over the last 5 years, with an average price of 1900 per aluminum ton, Alcoa didn't make any money. Plus, there are other legacy issues that really make it difficult for Alcoa to live, and that's also the reason why the stock went down the drain in March. Because if you look at debt, but especially pension obligations, so long-term debt is 1.7, 1.8 billion, now perhaps they lower it as they sold Warwick by 700 million, but still there are pension liabilities. 1.5 billion, 749 million, 606 million. And when you sum those up, and when the market crashed, then the value of the pension fund they have, the assets, crashed, and these liabilities increased. So the market recovered, so these liabilities go down. But that's also something to keep in mind. These pension legacy long-term obligations, which are common with long-lasting American businesses. They changed from defined benefit to flexible benefit plans, which saves a lot of companies these days. But these legacy issues can destroy a company, and that's what's going on with Alcoa, alongside low aluminum prices. So the stock is clearly cyclical, depends on aluminum prices, as I said. The fundamentals don't look good. The production cost doesn't have a moat, it's simply a price taker, and there are these legacy issues alongside the debt that I don't know when will the company be able to repay. Yes, there is production in the United States, but difficult to compete with other Russian, Chinese subsidies and other technical advantages that Alcoa simply doesn't have because of its long-term history. However, the volatility is amazing, and as I said, you could have played many times on these peaks that constantly happen ups and downs, but you need to know what is the risk, and the risk is there in the form of pension liabilities and other liabilities. On the government involvement, the US tried to sanction Russell to push prices higher, so there is positive help. We'll see later after the election in the US what will happen, but I don't think there is a margin of safety with Alcoa. The debt issues are there. It's pure betting on aluminum prices and whether there will be something or not. So this is a stock I will not cover or follow. Plus, it's a dying company. I'm saying they are selling the crown jewels because they just sold the Warwick mill to Kaiser. Let's go to Century Aluminum. So over the years, very volatile, and then even worse than Alcoa, hitting rock bottom bankruptcy prices when aluminum prices are low. This company is owned 46% by Glencore, so the bigger company is manipulating, trying to get some value there, but they have 4 smelters, not profitable at low or medium aluminum prices, high debt. So really ugly situation, and I don't know whether Glencore will be able to extract some value from it. But why is then the stock going so up and down, and who is pushing the stock up? Well, the stock is included in 58 ETFs and other index funds, so whenever somebody is buying a metal ETF because they think metals is going up, then the ETF buys this and pushes the stock higher. So that's what keeping the stock alive. Another stock that I would not bet on. A stock that's much more interesting is Kaiser Aluminum. Kaiser Aluminum is a great business, and you can immediately see it on their stock price. As you can see, it is volatile alongside industrial demand, but it has really been compounding slowly and steadily over time. Then, of course, March crash didn't recover immediately as there were fears related to aerospace, and now it exploded back to normal levels. But an interesting stock to watch, especially if you want to wait for those 1-2 times in a decade opportunities to buy it on the low when the market is concerned about the American economy. Now, this is a specialty business, so I think that even Buffett might be interested in something like that. Perhaps 1.6 billion, that's the market cap, doesn't move the needle for him, but the business fits Buffett characteristics. So they are specialty businesses. They don't produce aluminum, they produce special products for their very large set of customers. And if I would compare this with the company that we analyzed here, 3M Stock Analysis, that we did in March, also with 118,000 patents, and something similar is also in the aluminum sector, Kaiser Aluminum. Very smart, different than the other bunch of aluminum just producers and price takers. What makes the difference? Well, they pass on the price changes in aluminum to their customer. They are paid for service, not for selling and buying commodities for the customer, which means they focus on different things, not really an aluminum stocks, more an industrial technology stock. And if we check how this worked on the revenues expanded steadily, 50% up over the decade, now down because of declines in aerospace, but they have kept increasing their margins. Growing margins means better and better earnings, the dividend has gone from 1 to 2.6. This is probably some impairment from exuberance in 2008. As we have seen, they have also been exuberant with higher stock price. They have done good buybacks, and the free cash flows have been constantly growing, which means that they are good at managing cash flows. Very interesting. Key is rewarding shareholders, constantly increasing the dividends and the buybacks. As the number of shares goes down, the dividend per share goes up. So the company is focused on shareholders. 350, 470, I am at 820 million in dividends distributed over the last 14 years. The company has grown 50%, so if they distribute $1 billion over the next 10 years, that's a good return just from the distribution, plus you get the growth in the future. In 10 years, the company will likely still be there. They have three segments: the automotive industry, aerospace, and the other engineering part, all real stable businesses, good customers with all these special parts that they produce. Let's look at my table, Excel table. So we have here all the stocks, Kaiser Aluminum. Oh, let me just show you where you can download this. You just go to my stock market research platform, and this will be open for free preview. You just click on it. I'll put the exact link so you can just click there and simply have all the analysis in PDF, and you just click here and you can download the Excel file. And if you want to read, come back to this video or just the details. You have every stock that we discussed here in a written PDF. If you get value from this, just click that like button. And also, if you want to see other sectors that I'm doing, the stocks that I'm covering, my portfolios, feel free to check my stock market research platform. I'll be covering two stocks from this aluminum, Kaiser and Norsk Hydro, and my value is for less than $1 a day. I cover those, I adjust through earnings, what's going on over time, hoping that over the next decades I get a few opportunities for low risk, high reward entries, in this case the aluminum sectors. I do that for a dozen and more sectors, and that's the value I think I give through the stock market research platform. It saves you a heck a lot of research time, that's for sure. So now that you have downloaded this, I have already inputted 80 million in free cash flows over this year 2020, but I think this, with the last Warwick acquisition, that we'll have to see in the next earnings how it will be impacted, but this might also be higher. It might also be 100 million in free cash flows, which then changes completely the intrinsic value. Even if they hit 120 million with 50 added from Warwick, that would be very, very interesting. Given low interest rates on their debt, then it might really be cash accretive. But let's stay conservatively now. I have put 80 million in free cash flows that can be distributed in dividends and buybacks to shareholders, so that's value. Then let's say they organically grow 4% over the next decade, 10% discount rate based on the expected return, and as these are dividends that can be distributed, let's say 4% dividend buyback yield, terminal multiple of 25, and then I get an intrinsic value of 1.7 billion for a 10% return, which tells me that the stock is undervalued compared to a 10% expected returns, which makes this a very, very intriguing investment, certainly a stock to follow. Best case scenario, we can put here 120 million. If they do it, I'll put here 80, and then grow at 6%, and then really it is a stock that can double, as it did over the last 10 years. Worst case scenario, let's say they grow at just 1%, lower terminal multiple, then yes, they can go down, as it happens in downturns. So really interesting to watch. So all in all, it is undervalued depending on the assumptions you put in. As I will follow it over the next earnings, I will adjust these assumptions and then see when it is a buy, also compared to the other stocks that I follow. But all in all, it's not a cyclical like an aluminum stock. it is just more an American industrial stock. It is a good one, it has high margins, difficult barriers to entry, because if you supply Boeing, they're not just going to change it for someone else. They need that product. Kaiser knows how to make that product, and that's a competitive advantage. Volatility, yes, based on industry. Their moat comes, as I said, from the specialty products. The margin of safety isn't really there. Okay, cheaper it would be higher, but no really margin of safety if everything goes wrong, that you have something to count on. That is not the case here, but it's a quality business and the government always tries to help. Aluminum Corporation of China. This is a government state-owned company. The stock is volatile as aluminum prices go, but you can see a declining trend. Because this is a government-owned company, and as I analyzed many Chinese government-owned companies, the interests are really not aligned with shareholders. What happens is that you get all these state-owned companies that then are forced to invest in other state-owned companies. Just look at the owners of China Aluminum. All state-owned companies, Chinese life insurance, blah, 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 blah. So all of them, and then the same happens to the company. They have to invest, buy assets in the middle of nowhere that accounting-wise do really, really well. But it's not that you see that reflected in dividends. And with Chinese government-owned companies, the Chinese government will tell you what dividends are you allowed to get. So they went public on American stock exchanges, got the IPO money, but since then they haven't been really friendly with shareholders. So it's a tough, difficult environment to look at. Beijing airport, they first built a competitive airport and then they forced all the airport to invest in that at different valuations. So not aligned, very hard to invest, and plus they keep investing, they keep producing, and therefore they lower the aluminum price globally for themselves. They have stopped investing a little bit, now they're repaying debt. We'll see what they'll do later. However, all in all, a stock I would personally avoid, no matter the price. Another very good company is Norsk Hydro. The stock is traded in Oslo, Frankfurt, and also on the OTC market. This is an integrated Norwegian global producer that has electricity, that has mines in Brazil, and they try to do their best with their products, value-added products, a little bit also like Kaiser does. So very interesting, good business. You're buying it closely to book value if you buy it now, but also the stock is very volatile. If you look at stock prices, extreme volatility. However, if we can wait, and that's why I'm going to cover this and update on my platform, if we can wait for these low fundamental, low risk situations, then we can really take advantage of these upsides that happen when things get exuberant. And these ups and there will be downs, so it's about following on what and when happens. Really look at this, oh my god, how much volatility there is, it's really crazy. But the volatility is there, but this is a normal, stable business. They are investing, their target is to grow EBITDA by 8 billion Norwegian crowns to 20 billion. The balance sheet looks okay, they have liabilities, but they have a lot of current assets that can be sold if they lower this. That's 20% of the market if they become more lean in managing. So not too much long-term debt, a little bit of pension provision. So you are buying this practically, the market cap is now around 80 billion Norwegian crowns. We are buying this at book value. They have been rewarding shareholders. The dividend, I calculated the cash flow, so we are at dividend levels of free cash flows even in the bad environment aluminum. So they have some pricing thanks to the hydropower pricing advantage compared to Alcoa, and that's something important when it comes to long-term fundamental investing. If we go to Norsk, I have taken what they pay for dividend here, slow growth rate over the next years, and when they finish their capital investment cycle, I have put double the EBITDA, double the free cash flow. So from 3 billion for dividends to 6 billion for dividends, that's their target. This will be certainly volatile, but I think that on average they can reach that terminal multiple with a 3% yield. The intrinsic value is above the current market cap of 100 billion Norwegian crowns. However, it depends also on the future. If the required yields are lower, then we are still fairly valued for 10% long-term return. Best case scenario, I've put higher growth, so this is a little bit higher. And worst case scenario, keep in mind there is the book value, the value of the assets that they have invested, which might give a margin of safety. But then it's always better to buy at a margin of safety that's not zero, like in this case, but perhaps at 50 billion, which is 40% down from the current stock price. This could give a margin of safety, and that's why I'm going to cover this stock fully over the long term. So cyclicality depends on aluminum prices. That is okay, not that much. They will invest, but that will depend on aluminum prices. How much debt will they have to take for their investments? Something to follow. The volatility is amazing because the fundamentals are sound and good and of a growing business, but the stock market is crazy with the stocks, so really opportunity to take advantage. They have some hydro advantage with low input costs, which is key, and as I said, the margin of safety is there, or will be there in a form of book value. So to sum up, aluminum has a fundamental bottom that gives it an investing, let's say, strategy over time, because demand is growing, but the market really gets exuberant, which is something we can take advantage if we follow carefully. This is what I'll be doing the whole year: stock analysis, sector analysis. If you like this, click that like button and consider subscribing. Looking forward to your comments, and I'll see you in the next video.